Today's session is on Community Economic Development Investment Funds, the Nova Scotia Experience. It's brought to you by the Canadian Community Economic Development. And today's session is also with the support of Thrive, Calgary CED Network, and Calgary Economic Development. Thrive has actually organized their regular monthly community capital meetup around this webinar and have about 25 people together listening in. They'll be discussing the session afterwards with Paul Sabai of the Alberta Community and Co-op Association's Unleashing Local Capital Initiative. So welcome to all of you in Calgary and also people around the phone in Winnipeg and Southern Ontario and others who have introduced themselves across the country. For those of you not familiar with CEDNet, we're a national association of several hundred community organizations and individuals working to create local economic opportunities that support an inclusive and sustainable economy. Here you can see a few of our members' logos. If you like the session today, consider joining us by becoming a member or signing up for our free e-newsletters. This webinar is part of a series. Past sessions include topics such as social return on investment, the resilience imperative, social impact bonds, financial management for sustainability, mutuals for microfinance, and many others. All of these past sessions are on our website. Today's webinar is divided into two parts. To start, we'll have a presentation by Chris that will last about 30 minutes. Then in the second part, I'll ask him the questions that you have posed in the chat box. Once again, you should feel free to pose your questions, comments, and any other information you'd like to share in the chat box at any time. Before we get into the presentation, let's just get a sense of who we have on the webinar today. You should see two quick polls pop up. One of them inquires about your familiarity with CEDIFs, and your interest in the session is the other one. So you can answer here. Sounds like our Calgary folks still have no sound. Perhaps, Nikita, you can try to communicate with them in the chat box to see if they're able to connect their sound differently. And while people are answering the polls, I'll do my introduction for the session. The CED, as many of you know, takes an asset-building approach. This means that one of the starting points for development strategies involves identifying local assets that can contribute. In addition to the skills and capacity of people, sometimes the local financial assets are less visible and more difficult to harness. But that financial capital is often there. Nova Scotians, for example, put about $600 million a year into RRSPs, and at most about 5% goes into local businesses. The CEDIF program provides a vehicle to capture some of that outflow and redirect it for local business development. The CEDIF program has been recognized as an innovative model for harnessing local assets for more than a decade now. Replicating the CEDIF model across the country was part of the recommendations of CEDNet's first National Policy Forum in 2001, and since then it's continued to grow and attract attention, most recently being profiled by the World Economic Forum as part of their recent Social Innovation Summit. I've added the link to that report to the resources available on the webinar page of our website. But what the World Economic Forum concluded is that CEDIFs are a powerful tool to keep more money in the province and to create jobs. The CEDIF program has now generated more than $50 million for local investment, all raised from local investors. Now, that size pool of capital, it's many different local funds, but altogether, it's a very large sum, nothing to sneeze at, rivaling some of the biggest impact investing funds in the country. So I know you all want to know how they do it, but before we start with Chris, let's just check in on our poll results. We see, in terms of people being familiar with CEDNet, the largest group are people that have heard little about them, and there's another larger group that is the first time hearing about them. There's 10 people that are quite familiar already, and 2 folks directly involved in it already, so they may have additional comments to make in the chat box. In terms of their interest, there's a lot of general interest around social finance and community investment, and only 7 people who want the $50 million as well. I thought we might get more on that suggestion, but there we go. So now it's my pleasure to introduce Chris Payne. Chris is investment manager for CEDIFs with the Department of Economic and Rural Development and Tourism at the Government of Nova Scotia. He's a certified management accountant and is on the National Board of Examiners for CMAs, and has completed the Canadian Securities course and the Canadian Institute of Chartered Accountants in-depth GST-HST program. So he knows his numbers. But most interestingly for us, he's been with the CEDIF program since before it began, supporting its development all the way along. So he really is the most knowledgeable person in the country on this powerful model. And he's graciously stepped in from his vacation to join us here today. So thank you for doing this, Chris.
Thank you, Michael, and thank you for taking your time to participate in the call and the webinar today.
Excellent. So perhaps a good place to start would be, especially for the people who are less familiar with the model, is just a quick overview, a CED 101 of what a CEDIF is.
Okay, a CEDIF, or Community Economic Development Investment Fund, one of the things certainly that we do in government is we have to create an acronym for everything, and it kind of is almost in a different sort of language that we speak in. But it's basically, as the name would imply, it's a local investment fund which is set up and capitalized by local individuals to invest in projects which will support CED. And CED has a very broad interpretation depending on who it is that's looking at this. So what it's really meant to do is it's basically a way that local people can invest their money into businesses which are going to operate into their communities, which will in turn then create wealth in the communities, create jobs, and also have an impact if it's providing a service which otherwise isn't there. So I see in the first slide, sometimes people, it's really difficult if you don't have any familiarity with a CEDIF to understand just how diverse these can be. We had originally, when we were talking about this back in the early 90s, it was something that we expected to see sort of the local small towns would have their Chambers of Commerce, Board of Trade type individuals that would be looking at doing things, and they would get together and we would expect them to form boards of directors and form a CEDIF and do blind pools to invest into small businesses across their community so that they could lend not only their expertise, but they also would have money available to invest in these. There's oftentimes the people with the money and the people with the business ideas don't run in the same circle. So being able to then get those people who've been successful in a community that know the networks that are important and also have some financial resources to put into it, it really makes for a good sort of supportive network to encourage new business growth. So that's what we sort of expected to see. But what we've actually seen is we have that in a certain number of instances, what we call our blind pools, which is communities getting together, raising money, and investing into businesses as they come up and have good merit. But we've also seen a lot of CEDIFs set up specifically to invest into a particular venture. So on the slide that we look at here, you can see there's a beautiful beach in Port Hood, and that is, it's just on this side of the Canso Causeway in Cape Breton. And what people notice there, it's sort of on the road to the Cabot Trail, which is a very well and famous driving route around Cape Breton. And people were, hundreds and hundreds of vehicles were driving past there every week, and they just said we need to find some way that we can get them to stop here and have some economic impact in our community. So they got together, they partnered with local churches to get some land. They also partnered with the local Al McGuinness Arena so they could use the facilities and the electricity and some of the plumbing and so on. And they put in sites for an RV park, which has been very successful. It's been operating there for, oh my goodness, probably about 5 years now. And so what that's enabled them to do now is they have some seasonal residents that stay there all year and come in and use the facilities of the restaurants and the hardware stores and things like that. And they also have an opportunity now for people that are going by with RVs to stop and to stay for a night or two and enjoy the facilities there rather than just simply driving by. So that's an example of something that no bureaucrat in an office, whether they're in Winnipeg or Calgary or Halifax, would ever come up with the idea that you should put an RV park in rural Nova Scotia. But that's what the local people found was something they wanted to do, and they were willing to invest their money and get the partnerships in place to do it, and it's been quite successful. So that's just one example. We'll go through many others as we go through the slides. But the key thing is that it's community ownership, it's community control. The government involvement is on the front end in getting your approvals in place and getting through the Securities Commission so that you have the letter of non-objection, the ability to sell shares to the local people. Once that's in place, this is run directly by the organization. They elect their directors in an annual general meeting. They raise their capital and they invest it into one or more projects. Michael, am I advancing the slides or are you?
You can advance them when you like. You should be able just to, by clicking on the arrow key at the bottom left there.
One moment, technical difficulties.
I can help too if you like.
Maybe you can just flip the slide for me.
Sure.
I can't actually see the arrow here.
A bit more background.
A bit more background. Thank you very much. Yeah, these were announced first in 1993. It was a then Liberal government, and Finance Minister Bernie Boudreau announced that it was going to be an enhancement to the equity tax credit program in Nova Scotia that would allow not only for investment directly into one business that registers, but to allow for the pooling of funds through a community fund where people can then put their money in and they don't have to go through the process and the time consumption of evaluating investments. They can put their money into a fund which will then vet the investments and make the investments for them. It took a number of years. It sat dormant on the shelf for a number of years, and about 1998, I was asked to basically make it work. And so we looked at what was happening, and at the time we had securities legislation that said that if you're going to do any public offering in Nova Scotia, you need to do a prospectus. And we had a CEDIF documentation that said that if you're going to do a CEDIF, you need to do a public offering. So we kind of had two different pieces of legislation that were kind of running headlong into each other, because you can't do a CEDIF if it requires a prospectus, because that's going to cost you, I don't know, maybe $400,000 to get done. So if you're going to raise $400,000, it's going to cost you $400,000 to do it. It just doesn't make any sense. So we needed to come up with a method that would be easy and less expensive. So we worked with our Securities Commission and with some consultants, one of whom later became the chair of the Securities Commission, to come up with an offering document that could be simple and used by people where they wouldn't have to hire securities lawyers to do this. This could be done within the community itself. So the nature of raising capital means that when we say something is a simple document, it's still 29 pages long before you put any ink on the page. But the document basically will go through information: who's involved, what's their background, is there any conflicts in here, what exactly will the investment be. So it basically tries to boil down a prospectus, and if you went through all the different varieties and all the different disclosures, and it tries to keep the most important information and just make it in a simpler, plain language format. So that was approved and put in place through regulation back in '99, and in the 99-2000 year, we saw our first 3 funds be launched successfully. So this involved, for those of you looking at this and saying, we'd like to do something similar in our jurisdiction, it involved doing an exemption to the Securities Act. And then it took our Department of Finance, corresponding with CRA, Canada Revenue Agency, to get these to be included, specific inclusion for an RSP holding. So they are specifically listed, so you can actually put your CEDIF shares within a self-directed RRSP. So that basically gave us the sort of the framework in order to move forward. And back in in 2000, we really didn't know whether or not people would do this. Would people be interested in investing locally? Would you be able to set up funds? Would you be able to develop the expertise locally to do this? So we were pleased to see 3 go out the first year and successfully raise their funds. And those certainly, it was a learning experience for everyone. We continue to learn all the time. There's always new things coming up. So going back again into the background, these can be either as a co-op or as a corporate structure. They have to be set up as a for-profit entity. For the first 7 years, roughly, there was a 30% equity tax credit attached. The current government, approximately 2 years ago, upped the tax credit from 30 to 35%, which puts a little bit more money in everyone's pocket. We also have what you call a rollover credit after year 5 and year 10. When the program first came out, the province offered a 20% guarantee to investors, so that if you, for instance, invested $1,000, you'd get a 30% tax credit, and if the whole investment went bad, the government would cut you a check for 20 cents on the dollar, effectively splitting the risk of whatever investment you were making into a small business in your community. That guarantee became problematic for government, as they needed to carry a contingent liability on the books for 20% of all the funds being raised. So they were looking to remove that guarantee, And in consultation with a number of the CEDIFs, we were looking and saying, what is it what other problems do we have? And with a 5-year hold period on the shares, if a fund goes and raises the money in the first year, and they're lucky enough to have it placed within a short period of time, after about 3 years, they have to start thinking about what are we going to do for cash, because we know a lot of people are going to want to get out after their 5-year holding period. So what we came up with was we eliminated the guarantee provision of 20%, but we replaced it with a rollover provision so that after 5 years, if somebody wants to hold their investment for a subsequent 5 years, they will get a subsequent tax credit of 20%. And after 10 years, if they've been very happy with their investment for 10 years and they want to leave the money there, there's a third tax credit of 10% to encourage them to stay. Obviously, if someone is just maximizing tax credit, they can move from one fund to another. But for someone who is into a fund and they believe it's well managed, it's doing good things in their community, it just provides an incentive and makes it easy for them to stay.
Just the last points there in terms of the failure rate, it sounds like a relatively low number overall.
Yeah, it's very low. I think on the slide it says 3 have failed. I think there's another one that is going to go down, so that would say 4. We're still under 10%, and if you look at these as new organizations that are done within a community by people who have never done this before, and they're investing in small businesses and startup entities, the failure rate for a new business is something like 50% or higher within 5 years. So to have vehicles where they're investing into these businesses at a failure rate of under 10% is really, really remarkable.
There's lots of questions coming in here. Let's just try to keep going through the presentation because some of them may be answered over the course of the presentation, then we'll come back to the others afterwards. You mentioned earlier, Chris, that CED means a lot of things to different people. Can you talk a bit about where CEDIFs fall in terms of the range between charities, social enterprises, and private businesses?
Yeah, they fall all over the range because each of the CEDIFs themselves are quite different. So you'll see an instance of what I showed earlier, the slide that had the Port Hood RV Park, the Sunset Sands RV Park, and that's operating as a business, but it supports the local arena by provision of revenue to them for services that are provided. So it's kind of in a different area. We've had some businesses that have invested into a pure venture that was going to be on the corporate extreme, and then we've had others that invested in things such as the Marigold Theatre in Truro that are very much a sort of a social aspect. So in general, most the CEDIFs, especially those that are set up as cooperatives, have a co-op philosophy behind them. There's not really any thought of the investor going in here to get an extraordinary return from their investment. People would expect to get their money back and some dividends along the way. But then there's others that are going to be set up as a pure investment vehicle. So I think sometimes what makes it difficult to understand the concept is also what makes them powerful in that they can go all the way on the spectrum, basically from an investment where people really aren't expecting any kind of return, but they want to see something happen, as long as it structures a for-profit entity, all the way up into something which is investing in a high-tech company, which the proponents hope will at some point go public or do some other sort of exit event. So they can be all over the map, and the CED, like I said before, some people think of CED in the sort of charitable sense, and others will think of it as any business that operates in my community is going to have some benefits. So there's a wide way of defining how you think of CED, and I'm sure if we had everybody on the line answer a survey in that, you'd probably get some pretty different opinions there as well.
Yeah, and so that's one of the strengths of this. The CEDIF is such a versatile tool.
It's versatile, and it's all locally controlled. So once a community sets up a fund, we're hoping these will be evergreen funds, and that people will continue to invest in them, and over a period of years they will grow into substantive sizes. I believe the fund in Sydney now that New Dawn runs is up over $8 million. I mean, it's a sizable amount of money, and at that point you can get some diversification, you can invest in things, you can have some staffing. So it's different as they get bigger.
What's the motivation of people who want to start a CEDIF?
Well, there's a number of different reasons why people will start them. A lot of times you'll have people that are they've been successful in business in their local community, whether that's owning the local car dealer or the cable TV station or whatever it happens to be. And they've certainly earned enough financial security for themselves and their family, but they want to do something more than just give to the local charities. They want to actually share their expertise. So sometimes they will become involved in these, and they can share their networks, which really helps to capitalize the funds, because you need to get the people that have the money in the community to be involved in them. There's also people will start these because they see a real need. So perhaps it's what Jeff and Deborah Moore did with Just Us Coffee, where they saw a need for a fair trade coffee and they needed something local, and they wanted to see this happen, and they used CEDIF as the tool to raise the funds. Or you'll see in Truro where you see people that wanted to have a performing arts center, so they decided, hey, let's do something around that, and the only way we can really raise this kind of money is through using a CEDIF. So the motivation is, most often the motivation is quite pure in that people are trying to give back to their community or to the broader community.
What's the picture we see on this slide here?
So the picture we see here is it's a former Empire Theatres triplex that was in Truro, and it was going to be torn down and either developed as a parking lot or condos. And local people said, this is an asset we don't want to lose, it's right downtown. So they bought it. They raised a little over $900,000, and they bought it and renovated it. It's now a performing arts center. There's some offices in there and a number of other things as well. So it's, again, another thing where the community really did this for the sake of the C and CED mostly, but they're also secured by a real property asset, which is going to be worth money at any point in the future. If the project doesn't work out or for some other reason, they would have that asset that they could transfer.
Can you take us? Oh, go ahead.
Just from a province of Nova Scotia standpoint, looking at the slides, I mean, why would Nova Scotia do this? There's, obviously, as it says, I mean, you need your businesses to be able to access money, and there's an awful lot of places out there that will lend you money, from government lenders to banks to credit unions to lots of quasi kind of bank entities that will loan money to you, but there's not a lot that will invest. So trying to get people to actually see the difference between borrowing money and having investors, it's very good. And for Nova Scotia, again, looking at this from sort of a provincial standpoint, there's a lot of money, as you said in the preamble to this, that around $600 million a year leaves Nova Scotia in RSP contributions. Trying to get some of that to stay here and invest in our own businesses rather than shipping it all away to be invested in public companies makes it easier for those companies here to succeed. And trying to keep that money local in the province so that it can churn in our economy and have impacts here rather than all being sent away. So that's why the province looks at this as a way, okay, if we can keep the money here and that money invests in our businesses and people get a return from it, that helps the business, it helps the local people, it makes people think about doing investing, so it's kind of a virtuous circle.
Can you take us through some of the numbers on the state of the program today overall?
Certainly. The number, I think I have to update the 48. We're up over 50 now because we had a couple of sort of late closures. So more than $50 million has been raised and invested by local Nova Scotians, and that number is really astounding when you think of the fact that there really is no promotion or marketing that attaches to this. Individual funds can choose to market and promote into their community, but there's no broad-based provincial push to get people to do this. More than 5,000 individual investors when you have a population base of around 920,000 people in the province, and you take out sort of the school-age people and other people that aren't investors. I mean, if you were to check in with any sort of mutual fund company or anything like that and try and find the stats for what they have, to find 5,000 individuals invest in anything in Nova Scotia is a really significant number. The next thing, which is kind of interesting, is you see a number of funds now are paying an annual dividend. So when these first got launched in the first few years, there was sort of an ongoing debate between people, is this an investment or is this really a donation cloaked as an investment? So now that we see the funds that are paying dividends annually, and they can only pay those dividends from earnings. They can't simply give you back your money as a dividend. It has to be what is called a non-liquidating dividend, which means it has to be from what they have earned from the investments they have made. So it's worked very well, and it's worked because the people that have gotten involved in it in the local communities have been very keen to do this very, very well, because they're using their friends and neighbors and family money, and they want to make sure that people are very careful when they're using other people's money, and so they've been very diligent. The other thing which has happened in the last few years is the province brought in what they call the community FeedIn tariff to try to spur locally owned, community-based energy projects. And that really, the COMFIT provisions require that in order to be eligible for the higher rate of power generated under COMFIT, you need to have one of these special categories. And the only category that's basically open to the public would be if it's owned through a CEDIF. So there's been a great motivation, and we've seen significant amounts of money raised over the past 3 years by CEDIFs that are generating local, mostly wind-based power.
Your last point there might answer the question that Ruth Muley just posed in the chat room, whether most CEDIFs are started with a particular project in mind, or are they developed as pools to find one or multiple projects afterwards?
Yeah, the numbers, and again, I should have it, I don't, but it's roughly about 40 of the funds would have been a specific project, and maybe 10 of them would be what we call a blind pool. So mostly it's driven by someone has seen a need. Maybe that's a company that needs financing, needs access to money for a particular different thing. But occasionally we'll see the ones that start up as the blind pool. So most of the time when you see a new fund coming, they already do know where the money is going to go. It's a rare instance where they say we're starting a fund and we don't know where the money's going.
How has the program grown over the last, I guess it's more than a decade, 12 or so years? We've
been lucky to see it grow in, as you can see on the slide, and if everyone else has color as well, I just colored the first year was $1 million, and it grew pretty quickly from there into the sort of 2.5 million range for the next 5 years. And then it jumped up sort of into a 5 million range into the blue areas. And in the last 2 years, we've hit some really big numbers, largely driven through the COMFIT wind. So you'll see that we expect, I would expect these numbers to stay reasonably consistent, the 7.5, 8.5, 9.5 million, maybe crack 10 for another year or two. And then from there, what happened is that a number of these funds started out and they continued and continued and continued. There's been very few that have stopped. There was one where the asset was sold and the investors were paid out. There's been 3 that have failed. We expect another one will. But I mean, for the balance of them, they all are continuing. And a number of them, like Justice Coffee, like No Dawn, like the Black Business Initiative, they come back to market year and year and year. So they just come back and they continue to raise money. So once they've gone through this process once, there's a pretty steep learning curve. And once the individuals understand the process, there's a great demand for these. I know certainly in the case of Just Us, they have people will be contacting them in the fall saying, are you guys going to be doing an offering this year? If so, we're interested in investing. So it's something that's taken a long time to get to the level here. I mean, when we first started, we were wondering whether we'd ever raise $5 million in total. And now, the last year, we raised almost double that in 1 year. So getting up to a number of, $10 million a year is a very substantive amount of money. And I think at this point, it's gone through all 3 political parties through its life cycle now, and all are supporting it. There's no sort of imminent threats to the program. So we continue to work very closely with Finance and Securities Commission to make sure that if there's any kind of issues that need to be resolved, we deal with those. So I think it's going to continue to grow. I think we're going to see some innovative ways it's going to be used, but I think there's no reason to think this isn't going to just continue to grow and evolve as we move forward.
That's terrific, and there's tons of questions coming in here, so we just have a few more slides to get through. Can you talk a bit about the incentive or benefits for investors, Chris?
Sure. What we see here actually is it's a nice picture of that's a Watts wind energy project in a place called Watts Settlement on the way to Sheet Harbour on the eastern shore of Nova Scotia. I just love the picture, so I just put the picture in there. It just it dwarfs the little settlement that it's in. but it's an example of one of the what they'd call, I guess that's probably a medium-sized turbine, and you see the logos of there's a number of other entities that set up to do wind power. So the tax credit itself is 35%. So and you can see the maximum you can invest is $50,000 per person per year, and if you invest $50,000, that would trigger a tax credit of $17,500. Just to be clear, a tax credit is much better than a tax deduction. This is actually cash in hand. So if you invested a number, say you invested $1,000, you'd get $350 back on your tax return. And it doesn't matter whether you're making $1 million a year or $10,000 a year. As long as you have tax payable in Nova Scotia, you get the tax credit. So it's very evenly based in that way. There's rollovers we talked about already after year 5 and year 10. And the other thing we have here is called an adjusted cost base. So under Revenue Canada, if you have an investment and you buy it, in this instance, using the example of $1,000, the adjusted cost base is $1,000, even though you've got a tax credit of 35%, so your real cash cost is $650, it carries at $1,000. So if you were to sell it later, any gains would be calculated off the $1,000, not the $650, and any losses would also be done off the $1,000. So it's just another factor which helps, assuming you haven't put this into a registered plan. The last bullet that's on that slide basically says that there's a carryback for 3 years and forward for 7. So if you invest money that triggers a tax credit higher than what you're able to use in a given year, you can carry that back 3 or forward 7 years until it's fully used up.
Terrific. You talked a little bit about the community-focused FeedIn Tariff. Can you show us or illustrate how the CEDIF model has complemented that program?
The community feed-in tariff, again, this is a lot of times one of my colleagues, Crystal Terrian, typically will come in from Department of Energy to go through the renewable electricity side of things. But generally speaking, the ComFed, it's trying to get small, locally owned community energy generators. So they Micmac Band Council, CEDIF municipalities, nonprofit groups, co-ops, universities, and biomass facilities can make an application to the ComFed administrator, who then will review the project and approve or not approve the project. So assuming this is, again, a project coming out of a CEDIF, the CEDIF will raise its capital at the same time as it's putting in its plan. It'll be doing its wind data tests, and once it gets its approval, then it can go forth and erect the necessary turbines, get the grid connections, and start generating power. I know certainly last year I was at one of the turbines at Colchester Cumberland Windfield outside of Truro, and it's really interesting to see there. And if you go inside the tower of the turbine, you can actually look and see, and it shows how much power has been generated. It actually will show you sort of how much money has been generated in the run of a year. And it's really interesting to see. You can actually see this as like when you look at the meter spinning down below and the turbine spinning above. It's actually you can just see it. It's money being generated every time the turbine spins around. So it's just very it's really interesting to see that.
Very, very impressive. So looking back over your long CEDIF experience, what would you say are some of the lessons that you've learned?
Well, I've learned a lot of lessons about things. Nothing is ever as easy as you think it is, and certainly nobody. You think things are a given and everyone will agree, but they're not. There's always someone with a differing view. There's always someone who thinks things can be done better. Certainly, people from sort of the professional, the banking industry, had some issues with government being involved in this and doing things to encourage small local investing. Weren't really sure whether this is a place where people should be risking their money if they're not really sure if they have the expertise to do so. But leaving those large issues aside for the time being, I mean, some of these lessons learned, I mean, you need to have business leadership as much as the community. You need to have the community involvement, but you need to run this as a business. As you're raising money from people, you need to make sure that you give them every opportunity to get a return on their money. The requirements to create this organization are like creating any other organization, other than the fact that you also have to go through the Securities Commission and get a letter of non-objection before you can raise any capital. The unexpected. It's always, maybe one of the key people involved gets a new job or has some sort of family crisis. So there's always the possibility that everything's moving along just the way you expect it, and then something can hit you from left field. So the better prepared you are, the more resilient you'll be to that. Successes and failures, there's a lot of common traits that we'll see from these, and you really need to have a deep commitment from the community and have some people in the community that are well respected that can go out there, talk to people, and people want to be involved with them and want to trust them with their money. The additional rounds of financing, people will sometimes look at the CEDIF and say, well, we can't possibly raise enough money in our community to do what it is we want to do. But you don't have to do it all in one chunk, because someone said about eating an elephant, you can't do it in one bite. I mean, you might have to go out to the market and raise $100,000 one year and continue to go out raising $100,000 or $150,000 each year. So you will eventually grow it, but it's not going to be any easier to do next year. So the sooner you get started at it, the sooner you'll start to build an expertise, start to build a reputation, and people will then become much more comfortable for doing it. Market for shares is an issue that's been around since the beginning. There is no public market to sell these into. So once you're investing into a fund, you have to understand that you're there for the long term. The fund itself can purchase your shares back, or you can sell shares to any other investor that is in the CEDIF, but there is no broad-based market. There's no clearinghouse for shares if you want out and nobody wants to buy them. IPO and tax issues, I think we can go past that one for today, and the last one being valuation. There's no professional valuation done on these funds. So if you have this into an RSP, typically speaking, it's either held at your cost or held at a zero cost. So in order to get valuations done, it's important, well, it's expensive is basically what it comes down to. So if you have a small fund that's made investments in 2 or 3 companies, in order to get the value of that, you'd need to do a valuation on the companies that were invested in. And generally speaking, the cost of getting that done exceeds the value that's going to come from it. We hope in future there will be some easier way that we can get some sort of valuation that may not be, audit validated, but it would at least give people some idea as to what the shares are worth. But that again is one of these, as we've evolved over 12 years, I think that's going to continue to evolve over a number of years as well. It probably will come from some of the larger ones that are raising a lot of money now under CONFIT, because they're going to have a lot of regulatory requirements and reporting requirements. So they may in turn develop something which is more broadly used for other funds.
All right, so by way of conclusions, any final comments?
Final comments from myself, certainly. We have, I work quite a bit with Prince Edward Island. They were keen to do something. The PEI Cooperative Council, Charlie Crockett and Fred Martins and their colleagues were really keen. They've done a lot of work with Diane Kelderman and our co-op council here in Nova Scotia, and they saw this as just something that really was a good fit for them. Wesley Sheridan, who's the provincial treasurer, which is sort of our equivalent of Minister of Finance, was also very keen on this. So I spent quite a bit of time going back and forth to PEI for meetings and community meetings and doing presentations to get the buy-in on this, and then they enacted the regulations. I believe they call them a Community Economic Development Business, or CEDB, rather than the CEDIF, but they're using the same regulations, the same rules, and they started to work on some of their first funds this year. I don't think they've had a successful closing yet, but I think one is imminent. New Brunswick, their Securities Commission continues to work with our Securities Commission, and obviously going forward, the more provinces that have this in place, eventually somewhere down the road we might be able to get a market whereby people can then have sort of a restricted market, that if you buy into one CEDIF, you can then sort of buy and sell into other ones. But I think that's quite a ways down the road yet. Certainly in Alberta, our friends Paul and his partners at ACCA are working hard and have done some interesting things there, which is a similarity to what we have going. And certainly in Manitoba, they have something similar as well. And some of this originally, we certainly had looked at some of their models for, I'm not sure if it was Manitoba or Saskatchewan had the grow bonds years ago, and some other things. So there's a lot of different things we had there. There's a lot of interest on sort of the academic front. The fact that it went into the World Economic Forum earlier this year. I presented at FICE in Montreal last fall. And there's just a lot of study from academics as to this is an example of government letting go and letting the communities actually make all the decisions, which is something that governments typically don't do. So I guess in closing comments, I'm just very happy to have this much interest in the program. I think the more jurisdictions that have it, the more likely that we'll take some of the bugs out of the system, and hopefully at some point in the future be able to buy into your local CEDIF as easy it would be to buy into your local mutual fund at the bank.
Super. Well, I think there's a lot of people on the call here today that would share that hope. But thank you for that marvelous presentation, Chris. We have a ton of questions here. I think this is probably the webinar with the most questions and interaction that CEDNet's done so far.
And my apologies, I see I ran a little north of your 30 minutes, but I think we had a little bantering back and forth on the phone.
That's right. No problem at all.
Good.
There's a lot to cover. So we have a lot of questions I've noted here. I'm going to unsync the presentation so that people can scroll through the presentation yourself and review particular slides of interest. And I'd like to start the Q&A portion with a question that was emailed in advance that I think many CEDNet members would share. In fact, Debbie Hagman posted a related question in the chat box here. It's from Eden at Kootenay Employment Services, who wanted to know if nonprofits in BC could be part of the CEDIF movement. To help talk about what's happening in BC, I asked Rupert Downing, who's Executive Director of the Community Social Planning Council of Greater Victoria, to join us to talk about their efforts to create an investment fund. But while Rupert unmutes his line, perhaps, Chris, you can start by talking about the rationale for Nova Scotia's decision to only invest in for-profit businesses and the role nonprofits can play in CEDIFs in Nova Scotia.
Sure. That sounds like a pretty lofty kind of question, but I'll bring it down to, I guess, from our experience. When the program was initially being done, if you go back to sort of the late 80s, early 90s, the flavor of the day back then was something called an ESOP, or Employee Share Ownership Programs, and a lot of different places were looking at putting these in place to encourage employees to invest back into their workplace. That, of course, has all kinds of problems from sort of a finance theory point of view, because if somebody invests their financial assets in the same places they are working, that's all well and good as long as the business is successful. But if the business fails, not only do they lose their job, they also lose their savings. So that was sort of a first step, and then from there it evolved into what we had was our equity tax credit system, which you don't necessarily have to invest in the company you work for. You can invest in any company you're sort of familiar with, and you have the basic requirements in place that would allow you to do so. And then from there it was, well, if we can get to encourage people to invest in companies, but for people to do that, for them to understand what the company is and to be able to make a rational decision, it takes a lot of work. So maybe we can do something more simpler. So if somebody was investing $500,000, they would go through a large due diligence process before they invested the money. But if someone's investing $5,000, they don't really want to put that much time into the process of investigating. So if we were able to find a way that we could pool small sums of money, and then you'd have the money to invest into these companies, that would work much better. So that was the sort of thought process behind it, to encourage many small investors to then create these pools of capital rather than trying to go out and find large investors to do it individually by themselves. So as to the question, I think it also talks about for-profit versus non-profit. The general rules that the Canada Revenue Agency puts in with respect to tax credits being put out by provinces, being able to put this asset into an RSP, along with being able to piggyback it onto the Revenue Canada tax forms, required that it be a for-profit entity.
Okay. So that's a pretty clear restriction, right, to start?
Well, it is, but then when you look at, there's a lot of creative ways to do things, and if you look at someone like a New Dawn or a BCA, those organizations are largely set up as nonprofits, but they will then set up a for-profit entity, such as New Dawn has with New Dawn Investments. So that is a for-profit entity set up as a CEDIF that raises capital and invests in for-profit entities, but it also will do some sort of relationship through a management contract or other ways back with the larger nonprofit.
And so would that for-profit be wholly owned by the nonprofit, or just have some sort of other relationship?
No, it wouldn't be wholly owned, but there'd be a relationship either through management contract or shared seats on the board and different things like that.
Interesting. Okay. There was a number of questions related. Oh, sorry. I wanted to ask Rupert to give some comments in terms of your plans for CEDIF pools in British Columbia. Are you on the phone, Rupert? It's *6 to unmute your line if you're able to join us. Doesn't sound like Rupert's here, unfortunately, so maybe if he's able to join later on, he can comment. But he did post a question in the chat box, and there was numbers related to the blind pool aspect. So, Chris, does the simplified statement of offering allow blind pools that don't specify that year's investments?
I'm sorry, Michael, again with that one, please?
So the simplified statement of offering, I think his impression is that the statement of offering needs to specify the investments that are going to be made. Can CEDIFs provide a statement of offering that don't specify what the investments will be?
Yes, that would be what we call our blind pool.
Okay. So the ID blind pool wouldn't have predetermined investments as opposed to the specific business investments, such as the other approach that you've seen.
Yes, exactly. So, I mean, either you're going to go out and, you're going to raise money to invest in X enterprise, or you're going to go out and raise money in a community to invest in enterprises in that community. Like what we saw, we have a fund, Black Business Initiative set it up, which invests in black-owned and operated businesses across the province. So they set that up. They didn't know where the funds were going to go. They didn't know the names of the businesses, but they did know any business they invested in was going to be either majority-owned or majority-operated and employing black individuals in Nova Scotia, so they could support that particular subsector.
Among the 9 that are paying dividends, is there any trend between them being either blind pools or specific investments? This is Todd Hoskins' question.
Hi, Todd. It's the ones that started out paying dividends first. We had actually it was a grocery store, a co-op grocery store in Bedeque, which is physically where I am right now, and they had gone through a renovation of their grocery store. And it cost them about $600,000 or $700,000 to put in new coolers and freezers and things like that. And they borrowed the money from the cooperative trust, but the amortization was too short. It was only 5 years. It was really causing them a lot of cash flow difficulties. So they went out and raised the capital in the community. And in exchange for raising the capital, they could retire what was going to be a bank debt, and instead they could pay an annual dividend back to their shareholders. So they started out paying around 4.3%. They modeled that same structure for a number of other small retail co-op grocery stores in Cape Breton. So they all kind of came out with a 2, 3, 4% dividend attached to them. Some of the larger community wind companies now are also doing the dividends in Watts Wind Energy, Colchester Cumberland, and I believe this year Wind for All, which raised the record amount last year. They'll be coming out with dividends in this year as well. On the blind pool side of things, certainly New Dawn has an annual dividend, and also Northeastern Community Investments in Antigonish. So there's not a correlation. Both the blind pools and the direct investments have examples where they're paying dividends, but not all of either do.
Can you give some examples of the average investment return in those dividends? Or?
Well, it's really difficult to say an average return because until you sell your shares, you really don't know what it's going to be.
Right.
So, on the average, of the 9 that have been doing dividends, you're probably going to see something in the range of maybe just a little south of 4% annually. The other difficulty in trying to determine what it is that you have for your return figure is, how do you account for the tax credit? If it's going into an RSP, obviously that's not something there, but there is a tax credit attached to this investment you wouldn't have somewhere else. So do you take that 35% in year 1? Do you amortize it over 5 years? I don't know. And then you have to make an assumption as to whether or not your shares are still worth the same as what you put in or more or less. So you'd have to make a lot of assumptions before you can do the return calculations. So we don't have the data, and unless we were to sort of roll up the program, we would never at a point in time have that data. As some funds sort of close down, we can do a sort of post-mortem on them afterwards to find out what the returns were annually, but it's really difficult to do at this time. If anyone on the line has a way that they think we can calculate those returns, I'd certainly be happy to hear it.
Valuation, yes. Another question on the pool aspect from Ashlyn is whether or not investors participate in the pools, participate in the choice of businesses that are being invested in.
Sorry, Michael, I lost you there again for a second.
That's all right. So whether or not in the blind pools, the investors are involved in the choice and the selection of businesses that receive investment, or is that managed by whatever fund managers or other leaders, and they just place their money in the blind pool? And
I think people, generally speaking, can be as involved or as not involved as they so choose. It's largely a function of the board of directors or a subcommittee of the board to determine who actually will be the companies that are invested in. So if somebody is interested in those kind of things, then they can let it be known that they're interested in doing that. But for the most part, these are decisions made by a subset. The exception being if you're doing a blind pool and you want to invest more than 40% of your assets into a particular entity, then you have to come back to the shareholders with a special meeting basically saying this is what we plan to invest, do you approve or not approve? So the only opportunity you definitely would have would be if there's a significant investment being made.
Okay. There's a couple of questions related to the failure issue. You mentioned there's maybe up to 5 funds that have failed so far. Lynn Markel asked, what happens when a CEDIF fails? Does it really depend on the particular fund, whether or not there's any return to the investors? Or?
Well, typically speaking, when a fund fails, it's the fund is basically set up as a way of financing one or more businesses. So it's the same as when a business fails. What happens? For the most part, someone has to go in and try and tidy it up, close the doors, so to speak. If there's assets, sell the assets off, and if there's any sort of residual income, that gets returned back to, first of all, pays off the debts, and then if there's anything left after that, it goes back to the shareholders. So typically speaking, if a fund fails, the investors are not going to be getting much back.
Okay. And in terms of the patterns discerned between successes and failures, Cindy was wondering if you had any other insight. You mentioned earlier that a deep commitment from the community is key to success. Do you have any other general trends you see making distinguishing between those that have failed and those that succeed?
One or more persons that are sort of driving the process forward that just will stubbornly continue to do so when other more reasonable people may stop. You just need to continue to push it forward, because otherwise it's not something which is going to naturally happen. You need to push it forward to get your approvals, and then you have to go into the community. You have to actively solicit to get your investment, to get the dollars to invest, and then you have to make it known what you are going to invest in. So it's just really just a commitment. You really need to have a commitment, and you need to have leadership, which is one or more persons that are willing to really drive this forward.
Okay. Folks in Alberta, Calgary and Edmonton have posted a couple of questions relating to the mechanics of the finance. For example, what institutions are holding the investments themselves, whether it's banks or credit unions? I guess most of this money flows through financial institutions one way or the other.
Yeah, it's held, I would think, by pretty much all the banks now, begrudgingly, and certainly through Cooperative Trust Company and through the Canadian Worker Co-op Federation. Right. Canadian Worker Co-op has a deal with Cooperative Trust. They can do sort of vanity plans. They can set up a specific RSP plan for your fund. So you can set up a specific RSP plan for a particular CEDIF, and then anyone that's investing will go in under that plan. So that's where certainly I would think the lion's share of the RSP is held, but I do know that it's, certainly I've spoken to a number of people at CIBC, Royal Bank, Bank of Montreal, along with some of the larger mutual fund dealers as well. So it's pretty well held in most places where you can hold a self-directed RSP.
Okay.
But that being said, the banks aren't particularly happy to hold it for you. They would much prefer to sell you a share of one of their own mutual funds rather than have you invest in one of these, which is illiquid. You have to hold it for 5 years. They don't have a possibility of getting sort of, commissions and things like that. So there is a motivation from banks to try to channel your money back into their own products.
Okay. Are the CEDIFs eligible for tax-free savings accounts holdings? Yes.
No.
No.
Not yet. It's on our to-do list, but as yet, the last time the regulations were reviewed, there was no such thing as a tax-free savings account. So it's on the list. Department of Finance has full intention to change it to make these eligible, but hasn't done so yet.
Great. We're just about out of time. I want to try to get to a few more questions. There's questions related to the size of communities using CEDIFs. Can you share an example of a large city, CEDIFs that have been set up in a large city using a CEDIF?
These really had the sort of their basis coming out of rural Nova Scotia and small communities where they really didn't have access to other sort of financial tools, and they also came from places that had a pretty strong background in CED. So no, I mean in Nova Scotia, I mean we don't have any large cities. I guess the closest thing we'd have to it would be Halifax. We don't have a large fund in Halifax per se. The largest fund we have was designed around a wind farm in Antigonish, which is near St. F.X. and the home of the Coady movement, the Coady Institute, and all the early work in the early part of last century around the co-op movement. So there's a lot of that, and also in Sydney around the New Dawn and BCA and some of the work from Cape Breton University. So there's a lot of areas like that, but we don't have an example in Halifax. There's been some funds, but none that would be engaging the whole sort of city. Probably the one that had the most profile in Halifax itself was the Seaport Farmers Market that invested money, and unfortunately that didn't work out. They sunk under their own sort of debt load.
And what would be the smallest size community that has a fund?
As small as you can imagine. I mean, the little place I'm in Badek here, I don't know, there might be 1,000 people in here, and I mean, they raised $800,000 to do one of these from 1,000 people, because people will come away from, and it's amazing in even the smallest communities in Canada that there's an awful lot of people that have money, sort of under their mattresses, wherever it happens to be, in savings accounts or GICs or Canada Savings Bonds or whatever it is. There's a lot of sort of people that have had money for a significant amount of time, perhaps going back generations, and if you can find a tool that sort of unlocks that and lets that money get back to work in the community, that's one of the things the CEDIF can do.
And for particularly, I guess, for small communities that might not have the resources or the expertise, are there any supports available to assist communities in managing and building their funds?
Well, the same tools that would be available if you were opening any other business. So, I mean, the province has staff in economic and rural development that will provide some assistance in this. There's also the federal government has their Atlantic Canada Opportunities Agencies. There's certainly people there that have some knowledge of this program. And I know of at least one or two funds that approached ACOA directly to get some funding. So you have those, and then within the communities themselves, there's sort of business development officers that work for particular municipalities, or there's regional development agencies. So there's a number of different places. The same way that if you were looking to open a business, the same places where you would go for assistance to do that, you would go if you were doing a CEDIF, because you're basically opening a business. It's just that the business of that business is to invest in others. So it's very parallel to that. And again, you can also, of course, certainly use the resources of the professional, legal, and finance and accounting communities.
Right. Okay. Our last two questions related to the role of the provincial government that CED had posted. In terms of the administrative cost, have you done any recent kind of cost-benefit analysis? So you talked a bit earlier about the benefit. Why would the Nova Scotia government get involved in this? Can you talk a bit about the role of the province behind all this, the program?
We haven't had an evaluation done in far too long. We certainly need to have one done. There was a tax credit review done, but I mean, this was must be in the early part of the 2000s, maybe around 2003. And at that point, the tax credit review, taking into account the cost of the credit and some inferred charge for staff costs and things like that, demonstrated that after 2 years, you'd have a positive return back to the Treasury. So the cost of the tax credit is fully repaid back through the incremental employment and the growth of the organizations without taking any spin-offs into account. But that's, as I said, that data is probably close to 10 years old. So the cost of the program for Nova Scotia, the primary cost, of course, is the tax credit itself. and beyond that, it's part of my staff time, and it's part of the Securities Commission and one individual at Finance. So there's a little bit of staff costs attached to it, but really beyond that, there's not much else. We have a sort of a sub-site from our Economic and Rural Development for CEDIF, which contains a lot of information. So again, there'd be some costs involved with the webmaster updating that, but generally speaking, there's very few costs attached to this program other than the credit itself.
Very interesting. Well, we're out of time, unfortunately, and I think we've covered most of the questions that people asked. It was a very engaging presentation, obviously generated a lot of interest. I'm going to resync the presentation now, and I've posted some more information. Chris, you mentioned the CEDIF program sub-site on the Government of Nova Scotia Economic and Rural Development and Tourism pages, so people have the link there as well as the link to the latest brochure. If you'd like to stay in touch, please consider signing up for CEDNet's newsletters, and everyone should have just received an email with the link to a 1-minute evaluation survey. Please take a second and fill it out right now. Your feedback is important to us. So finally, many thanks once again to Chris for sharing his unique expertise, and to Thrive and Calgary Economic Development for co-sponsoring today's session. And thanks to all of the participants for the questions and the participation. The webinar recording will be posted on our website, and we'll be sending you the link as soon as it's available. Have a great rest of the summer, everyone. Thanks so much, Chris.
Thank you, Mike, and thanks everyone for signing in for this, and I look forward to getting lots of interesting emails over the coming weeks.
Yes, there you have Chris's email address, so when he gets back from vacation, he can look forward to a very full inbox.
Excellent. Okay, thanks again.